right. So Sarry, man, take us back before real estate. I mean, in the business that you're in, not real estate. I talk to realtors so much. Take us back before thinking like a bank, and all the stuff that you're doing right now. And tell us again how you got into this profession in the first place.
Yeah, well, first of all, David, thank you so much for having me on here. It's a pleasure to speak to you and the audience today. I'm excited. So yeah, a little bit about me. I grew up in Chicago, Illinois, and my career, and I'm a financial planner today, but I wasn't obviously always a financial planner, nor did I think I was going to get into finance in general. But the journey really started when I had to take a class. It was my senior year of high school, and I had to take a class called Consumer Economics. And the class was just a very basic like business class. It was how to write a check, what is interest, what is a mortgage. And I love that class just because I think it was like so important and so relevant, right? I think academics should do more of that, have more business classes rather than just like art history and humanities. We should take more like business oriented classes about like real estate investing and things like that. So I wanted to make a career out of that, like helping people reach their financial goals, helping people with like credit, money, finance, things like that. But I was still looking new to it. I didn't know what that was called, right? So I got my bachelor's degree. I got my MBA. I thought my MBA would lead me more towards the business route. It kind of did a little bit, like 10% maybe, but the rest of it came from like real world experience, like dealing with people. I started working at Allstate Insurance. That was my first professional job.
No way. Okay, I gotta stop here. I worked for Allstate before getting into real estate. Keep going.
That's a small world, yeah. And I loved it. I loved their systems. I loved their business model and helping people and talk. I was in sales and marketing, so I was like dealing with people, and I started to notice this different trend happening where it wasn't just so much about how much am I going to pay for auto insurance or homeowners or life insurance or condo insurance. It was more of how do I protect my things? How do I budget? How do I mitigate risk? How do I save for the future? That's how the conversation started to shift. And I started becoming more of like a financial coach rather than just a licensed insurance agent. And luckily people started to view me that way as well. So I wanted to kind of go deeper into that financial coaching world and financial strategist world. And luckily I read the book, The Bank on Yourself Revolution by Pamela Yellen, as I was doing research on like financial coaching and financial planning. It's a book called The Bank on Yourself Revolution by Pamela Yellen. And it talks about this concept, the bank on yourself concept. And you and I, before recording, we were talking about infinite banking. So it's primarily the same thing, and just different trademarks. But the underlying asset is the same thing. We're using cash value whole life insurance to become our own sources of finance. So fast forward to today, I have a company called Financial Asset Protection. And that's exactly what we do. We use cash value whole life insurance for real estate investors, business owners, full-time employees to become their own sources of financing and to take control of for them to become their own banks.
Really cool. And I'm excited that we're having this conversation, man, because you know how TikTok and Instagram is like is creepy accurate now. And this has started to pop up in my world more and more. Mm-hmm. And oddly enough, I was in insurance for 7 years. And I never had once heard about this like concept of bank on yourself, infinite banking. And yet now it seems like it's becoming more like, wow, this was a hidden gem that we now have to unearth for, we've got to democratize this in essence. And so I'm excited to kind of like talk about these things. What was it specifically that so excited you about, starting to take on this, you said people started to like view you more as like this financial resource. Like what excited you about kind of taking on that new persona rather than just being a straight up, insurance salesperson assassin?
Yeah. Yeah, exactly. It was the element of help, right? It was like it adds more of a layer of importance to what you're doing if you're actually helping people rather than just the title of sales, which has in most situations, the term sales has like a negative meaning, right? Like we try to avoid that. But so when I started, noticing people looked at me more as like a coach or consultant, it added more importance to what I was doing. And I enjoyed it more that way, from that perspective, rather than just a job or just a career. The table changed now. And now luckily, people come to me now for like all types of, there are certain things I can't help with. Like people call me up and say, hey, I owe the IRS $20,000. What do I do? I don't know. I'm not a tax professional. You need to deal with a CPA or a tax attorney. I can't help you there legally. And knowledge of that, I don't know what to do in that situation. So that's kind of what really changes. It added an element of importance to what I was doing and helping people.
Yeah, I love that. All right. So let's dive right into this concept then. Yeah. Like when you say bank on yourself, or thinking like a bank, just give our listeners like a high level overview of like what that means and why that should matter to them.
Yeah, exactly. So if we think about like we're going to buy a car, we're going to buy a house, we're going to get a job, we're going to work, for the next 20, 30 years. A lot of that primarily deals with banks, right? Third-party banks. Like we're going to get a car note, we're going to get a mortgage, we're going to get a business note, a personal note, student loans. So we're kind of in the situation, like I think everybody is, most people are in the situation where they're constantly working for the banks. If you think about it, on average, the American spends 1/3 of his or her income servicing debt. So if you make $100,000 a year, on average, 33,000 goes to your mortgage, student notes, student loans, car notes, credit cards, personal debt, and other types of financing. So again, we're in the situation where we are indirectly working for banks, and banks are sitting back, earning principal and interest from everything essentially that we're doing and moving in our lives. So what if we could reverse that, right? What if we could sit on the other table where we are the bankers? We are recouping that principal and interest back into our pocket rather than going to somebody else. That's what thinking like a bank primarily means, is that we're changing the table now. We are becoming our own bankers. We're controlling the terms. And more importantly, we're recouping the interest back into our pocket. So that way it's not going to other people. So that's kind of like the foundation of thinking like a bank.
I absolutely think that's the coolest thing in the world. We have the saying, I throw it around to my agents a lot. It's change the way you look at things, and the things you look at change. And so, sometimes we can have this negative aspect of like, these service charges to the bank and the interest and all this stuff. And yeah, a third of my income is going to the bank. And we can just have this like negative, like victim mindset, or we can change the way we look at things, just like you said, Sarry, and we can start saying, well, how obviously they've taken advantage of this opportunity. Mm-hmm. How do we take advantage of that opportunity as well? So start to like kind of share with us, like, all right, I'm changing my mindset on this.
Yeah.
Now, what do I actually have to do to take action on this? What does it actually look like in day-to-day life? Is it just mean I'm like taking my savings account and I'm just, mm-hmm. paying cash for everything? Like, what does it actually mean?
Yeah, exactly. What does it mean? So we are, this is mentioned in the book Bank on Yourself Revolution, right, by Pamela Yellen. And it's also mentioned in Becoming Your Own Banker by Nelson Nash, which is who really kind of invented infinite banking. So in these books, both of them, they're talking about using cash value whole life insurance, and like why that, right? So there's and I'm doing the CFP work right now, the Certified Financial Planner courses. It's like 7 courses, and in these courses, there's about 450 different financial vehicles out there, from stocks, bonds, mutual funds, index funds, all types of financial vehicles out there. And of all the financial vehicles out there, there's only one that could help people regain interest back into their pocket, save on taxes, pretty much have tax-free retirement, mitigate market risk, take control and have liquidity in their vehicle. And of those 450, the only one is cash value whole life insurance. I could do that up to date. Right. So that's a big thing now. So we're not just thinking of what kind of rate of return can I get, or what does this investment sound like, or what is this? We're not thinking more of the title. Thinking like a bank, we're going deeper into other elements of this. We're thinking about how risky is this? How much interest do I get to pay? Do I pay for this, or do I get to earn from this? How liquid is this, and how much control do I have? And also, what is the tax liability? So there's other factors to it. That's kind of what thinking like a bank means, is that you're looking at different factors of an investment vehicle. Whereas most people, even when I talk to a lot of clients, one of the first questions they're asking is, what is the rate of return on this? And that's of course the consumer mindset, believe it or not, David, but that's the consumer mindset to have, is that what's the rate of return? Because there's other elements to that. It's like when you go buy a car right now, you don't just ask how much horsepower is this. It's nice to have, a lot of horsepower because it means the car can go faster, but that's not the only thing you're going to buy a car based off of. And that's how investments work the same way, and saving your money. It doesn't work just based off of solely on the rate of return. There's the taxes, there's the interest, there's the market risk, there's the liquidity, and other factors like that.
Okay, that's super helpful to me. And one of the first things that like pops into my head, Sarry, is there's some very prominent financial advisor superstars out there, which would say like a cash value whole life policy is a horrific like investment. Mm-hmm. Like if you're going to go in the insurance route, like you pay as minimal as possible into a term policy. I'm not going to mention names, but it starts with D and it ends in Ave, and so like he has this like very negative mindset, and that's a very prominent voice in the real estate community as it pertains to finance and just Americans at large. And so like, how do you start to like I know it goes back to mindset, but like, what do you say as far as like, who is this a great vehicle for with all these other factors that you just mentioned?
Yeah, and that's a good point, David. So yeah, definitely it's so what he's saying, this financial person, what he's saying could be true, right? It could be that a whole life policy has barely any cash value, barely any returns, and could be a terrible investment for somebody if it's structured the wrong way. So if it's structured the right way, it could change a lot of things for you. Well, now, what do I mean by that? So there's about 2,000 life insurance companies in the United States that sell life insurance. Of those 2,000 companies, only three, maybe four, depending on the product they have, three or four companies could actually do infinite banking or high cash value whole life insurance used for investment purposes. And then within those companies, they each have like 10 different products, and each of those products has like 10 different ways of structuring it. So it takes a knowledgeable person to actually like know exactly what they're doing, and not just, hey, I listened to this podcast with David and Sarry, I'm going to go out and buy this whole life insurance policy. No, there's more to it. That has to be structured properly so that the cash value grows significantly over time, so that it's tax-free, or it's not, it's called not a modified endowment contract, not a MEC policy. So it grows tax-free. It earns you dividends, and really importantly is that it keeps growing even when you leverage it. So when you have all these elements in place, the growth, the taxes, the interest, all these different parts of it, there's really nothing out there that could do all of these things. Yeah, I could go buy stocks right now. I can put $100,000 in the stock market, turn around, go to a third-party bank, borrow out like $50,000 against those stocks. So that way I still have the stocks. I can take out money and I can go buy real estate. Sure, a lot of people do that. Instead of selling their stocks, they leverage them, they borrow against them. However, there's some downsides to that, such as the amount of money you can borrow against. Typically, it's like 30 to 50% you could leverage against it. And then those loans are callable. That means that if your stocks decline in value, which happens, that could happen in the next hour, the stock can decline in value. The bank can call you and say, hey, your value of your stocks is going too low. We need more money now to get it back to that 30 to 50% loan to value ratio. If it goes too low, then they can call they call the loan. That can't happen with whole life insurance. If it's structured properly and you're borrowing against it, you can go out, do real estate, you can go out, do other things without having to worry about the insurance company calling you saying, hey, your account is too low, because it doesn't decrease in value. So just these small things of going deeper into what it is and deeper into the concept, more into the concept than just the product or the title of it, it changes everything. It really it spins a table, and it gives somebody an advantage if they just did a little bit more homework and looked more into the details of things.
Yeah. Wow. Okay. That's super cool. So, what about like if someone, like when you're talking, obviously a lot of my audience area are real estate agents that are doing really, really well. They're earning a great income as a 1099 independent contractor, typically with their brokerage. They could be W-2, but typically they're a 1099 contractor, could be earning, $250, $350, $750,000. Is there a certain income level or net worth? Like I have new agents that are listening to me that like aren't making that much money. Is someone looking at a vehicle like this, typically someone who's going to deposit, $200,000, $300,000, $400,000 into this to start it? Or is it can someone like that just starting out, start funding a policy at 20,000? Like what is the typical dynamics around that?
Yeah, awesome question, David. Awesome. Yeah. So it could be anybody, literally anybody from who's still a part-time student / part-time employee in college, all the way to somebody who's 60 years old and has 500 real estate properties. It could be that big of a span. I'd say the only thing you would need really is just a few $100s of disposable income, meaning that you earned your income, you paid all your bills and all your expenses, and you have $200-300 left over at the end of the month. This can work for you, and this can even amplify other things that you have going on, as far as saving money and then finding other investments to invest in while you're doing this. So this doesn't replace. So let's just say, for example, somebody says, yeah, I have $300 a month extra, but I need that for emergency purposes. Well, this could be an emergency vehicle. Also, if somebody says, yeah, I have $300 a month, but I need to save it for my business I'm going to start in the next 5 or 6 years, this could be used for that. So it helps amplify what you're currently doing, and it doesn't necessarily take you away from what you're doing. I started my first policy with $300 a month, that's a lot of clients do that. And then some clients do like lump sum single premium cases where they're just doing like a one-time payment of like $400,000. That happens too. So really the most important thing is you have a growth mindset and you're open to learning more. If you have those two things, we can work with you. You know, I always do a financial analysis with clients. It's like a 1 hour meeting. It's the most important meeting that we have. It's 1 hour long. We do it over the phone or over Zoom. And it's just me understanding the client's financial situation, where they're at right now, where they want to go, what kind of retirement plans have they already built, what are some goals they have, what are some concerns they have, obstacles they face, things like that. You know, where is it they want to go financially? And then from there, we would build out either a cash value whole life insurance, or it could be different things. Like I work with a lot of real estate syndicators that use whole life insurance for passive limited deals and passive real estate opportunities. So it could be that with whole life insurance, it could be that in private money lending. Really, where the client wants to go, it's really important to identify where they want to go and kind of some of the obstacles that they've seen and how we can eliminate or even mitigate some of those obstacles.
That's really helpful. What
Mhm.
could we walk through just like maybe just a real simple example of like just a use case
Mhm.
for, okay, so I've set this up, I funded it, I
Mhm.
have a certain amount of value in my policy. Now I want to do something with it. And I don't care what example we use,
Mhm.
but something that just walks us through kind of the nuts and bolts of borrowing against that and what
Mhm.
happens when you borrow against it.
Yeah, good question. So like just a basic example. Just these are some numbers, so don't hold me to these numbers. So I'm just gonna kind of like try to remember them from a case I recently worked on. So for example, just to use even numbers, you take $100,000, you put it into a whole life policy, right? It's a single premium policy. So that means it doesn't require any future payments. It's just a one-time payment. And then from there, you could probably borrow out in the first year about $85,000 as a loan. And then let's just say you take out that loan, 85,000. Let's just say you put all of that into a real estate deal, right? As a limited partner, and you're anticipating on doubling this money in the next 5 years. So in the next 5 years, you're looking at about $170,000. Let's just assume that there is no distributions or cash flow during that time, just one-time payment of 85,000, and then 5 years later, you take out twice that money, just to make these examples easy to understand. Now, two things happen here, right? We took that money, we doubled it in 5 years. And then the other thing is too, when we put in the original $100,000 into the single premium whole life policy, it kept growing even with that outstanding loan against it. Let's also assume we're not going to pay this loan back until we get paid from the real estate deal. So we took out that loan. Now, 5 years later, this cash value, again, I have to probably check out the numbers again, is probably going to be about maybe maybe $110,000 roughly. Now, what's the big deal, right? We put 100,000 in year one. Now it's 110,000 year five. Well, the amount of interest we paid to borrow this money is going to be significantly less than what we earned on that money. So we borrowed that money from the insurance company. We paid interest to the insurance company, but we're also earning interest on our money. So the interest we earn on our money outpaces what we paid to use that money, if that makes sense.
Yeah.
So the policy kept growing. We made money in the policy and we made money on the real estate deal. That's just one example over 5 years.
So essentially, the like, to boil it down, and correct me if I'm wrong,
Yeah.
essentially one of the wins is that when you borrow against the value of the policy,
Yeah.
the spread between what you're paying in interest and what you're earning in cash value is such that you're actually making money. Typically, I mean, if it's structured correctly, that's the whole concept.
Precisely. Good job. Yeah, exactly. So you're literally earning more money even when you have that loan outstanding. Plus, you're making money with your investments on the side. Plus, the growth inside the life policy is not connected to markets. It's not connected to the real estate market. It's not connected to anything. So when there is a crash, like in 2008, cash value whole life insurance policies were not hindered by that. So that's another factor. Plus, that growth inside the policy grows tax-free. Plus, you always have control. There's no like for example, with 401ks and IRAs, you have to wait until you're 59 and a half to access that money. With life insurance, you don't have to wait. Now, there are some stipulations, like if it's a modified endowment contract, MEC policy, then there could be taxes when you take out money prematurely. So just to kind of look out for those things. In 95% of situations, we structure policies to be non-MEC, so not modified endowment contracts. and so that they're completely tax-free and they're completely accessible regardless of age. 5% of the time, we do intentionally structure a policy as a MEC because it's still advantageous for the client. It's still tax favored. It's just not as tax favored as a non-MEC policy.
So can you just keep going on that a little bit deeper? Why would it be advantageous to the client? Like in what situation?
Yeah, so even so what MEC means, MEC, what that means is that if you once you reach gains in the policy and then you access the policy through loans or withdrawals, the gains could be taxable to you as ordinary income. And then you can also pay a 10% tax penalty if you're under the age of 59 and a half. So this is what I'm going to, you're going to take money out of the policy. You would have to pay a tax only on the gains. However, let's just say, for example, the gains are like only, $5,000, then you're paying ordinary income taxes on $5,000. And let's just say you're in a low tax bracket, like in the 10% tax bracket. Then you're only paying like, 10% taxes on $5,000. So like $500. And then let's just take it a step further. Let's just say you're a real estate professional, and then you could take some, and you're invested in real estate. You have some properties. You could take the losses against that income. So there's a little bit more kind of to it. But in most situations, we try to stay away from MEC because we want it to be all tax-free. The loans tax-free, the withdrawals tax-free, the growth, the life insurance, all around kind of tax-free. And then kind of to go deeper, like why does MEC even exist if the audience wants to know that? So prior to 1988, a lot of millionaires and billionaires were just stuffing as much cash as they had into whole life policies. And then they were just, because of the growth was tax-free, the loans were tax-free, everything was tax-free about it. And then Congress and the IRS had to like put some red tape around the industry. They had to kind of like slow people down, and they created the TAMRA Act, TAMRA Act, which says in there that there are MEC policies and that there are methods of ways of calculating what a MEC policy is. So that's kind of, I know it's a little bit more than needed, but it's just
no, that's really helpful. I mean, as the government tends to do, they step in and they put red tape, because I mean that's the beautiful thing about capitalism is entrepreneurs always find a way to utilize everything to their advantage, and sometimes those need revisions. So that's cool. So this is a very elementary question, but I know people are probably wondering. So when you take a loan, that $85,000 loan out against the policy, is my interest still growing on the original 100,000 or only what's remaining in the policy?
It's non-direct recognition, so it's growing on what was originally in the policy. So whether you take out a loan against the policy or not, the cash value grows either way.
Wow. Okay. So, I mean, we just spent probably 10, 15 minutes going through a bunch of the ins and outs and a lot of the positives of this. I mean, let's just play like devil's advocate here. Like, what are the downsides of doing something like this? Because I mean, right now, I think a lot of people are saying like, okay, well, I have $100,000 sitting in a savings account that I don't want to throw into the stock market because I'm a little less liquid. But this sounds like it gives me so much flexibility. There has to be some type of downside and risk involved, right? I mean, what do you have to say about that?
Yeah, so risk, there really is no risk at all involved in this because of the way that insurance companies operate and how they're regulated. So from a risk standpoint, there is no risk. However, the one downside is that when you start the policy and you're putting premiums into it, there's going to be a difference between the premiums you put into it in the first couple of years versus the cash you can access in the first couple of years. So like year one, if you put 10,000, so let's just say you do a policy. Let's just say you are, 40 years old, you do a 10-year policy where every year you're going to do $10,000 a year. Year one, it's going to be the access you have is only going to be like maybe $6,000 or $7,000 of access. And then year two goes up. And then eventually by year 5 or 6, it breaks even. And then it keeps growing after that for life. It keeps growing after that, even after that 10-year funding period. But the downside that I've seen from a lot of people is, what about those first couple of years? How come if I put 10,000 in, how come I can't take 10,000 out? Because there's a cost to the insurance. It's not free, right? There's still whole life insurance involved. There's still a life insurance death benefit. There's still, the operating expenses for setting everything up. So that's something that I think people see as a downside. But the upside to that downside is that you end up getting that money back in the later years. You end up recouping your original investment plus more. So I guess time is the only thing that you really need with this, time and patience. But even with the patience part, you still have, I think when you say patience, it might imply that you have to wait until you access the money. And that's not true. You can access the money from day one. You just can't access all of your money from day one.
Okay. Yeah, that makes perfect sense to me. So, is typically the death benefit tied just to that? Like, if it's a single premium policy for $100,000, is that typically what the death benefit is?
It's
Or is
typically
it
to be much more. It's
okay?
depending on the age, there's a multiple. So like somebody who's, like 40 years old does a whole 100,000, the life insurance could be like $500,000. So like 4 or 5 times. And then it could even go more than that. Like if somebody's like 25 years old, it can even go, the spread could even be much greater than that. But usually the premiums, the life insurance is much greater than the premiums.
That's helpful, because I think a lot of, and the reason I asked that question, Sarry, is because a lot of real estate professionals, I find come into my company with very limited knowledge of a lot of these things. They're coming from other industries, servers, bartenders, whatever.
Yeah.
And they're just starting to learn some of these like business concepts. And one of those is, life insurance. And so even stepping before this whole infinite banking, thinking like a bank concept, like I really want listeners out there, I want you guys to be thinking about protecting yourselves and your family.
Yeah.
And so the death benefit portion of this is just a significant benefit to these policies, and something that you need to be thinking about in one way or another, structuring. And I talk to you guys a lot about structuring your businesses such that your businesses are protected, through LLCs and other structures. But you also have to be thinking about this from your business, from your familial standpoint as well. So, Sarry, like this all is like super helpful and awesome. Where it seems to me like maybe in days gone by, and I think I referenced this at the very beginning, like this was something that was kind of held behind a curtain. Millionaires, billionaires across the United States were using it to their advantage. But it seems like it's coming a little bit more mainstream. Like, why do you think that is? Like, why is it kind of on the scene all of a sudden in the last like 5-10 years?
Yeah, you're right. So like I think a lot of people never even heard about this concept because like if you take a step back, like conventional wisdom teaches us, right? Like you put money in the bank, you pay off all your debt completely, like no debt at all. You put money in the stock market and 401ks and IRAs. And a lot of people grew up that way, right? Their parents did that, their grandparents did that. A lot of grandparents are from the Great Depression era or the thinking part of the Great Depression. So it's saving, So I think that when you come in with whole life insurance and you start talking about this, people are like, whoa, this is completely outside of my paradigm. My family didn't believe in this. My teachers didn't believe in this. My friends, not like this doesn't exist in my life. And that's true for a lot of people, right? It's not a common thing where like, oh, everybody does this thing. But you're right. Lately, it's been more trendy. And I think any concept that is valuable nowadays could be trendy because of the reach that YouTube Shorts and TikTok and Instagram have on people. Like today I could, share something with 100 people instantly, through social media means, or even more than that. So a lot of people are becoming, even my friends are calling me like, hey, you should get on social media. You should do these, reels or whatever, talking about cash value, whole life insurance. And I haven't really, I have a marketing person helping me like set some stuff up, but it's not that aggressive yet. But yeah, lately it's becoming a little bit more trendy. But to your point, it's because a lot of people, I guess like as humans, we have this like natural thinking where it's, if I didn't know about it from before, if my family didn't tell me about it, if my friends didn't tell me about it, it doesn't really matter. Like it's like that's kind of, we have that natural filters in our mind where especially when it comes to investing money and saving.
Well,
money.
like you said, you use the word paradigm, right? Yeah. And we constantly talk about, I mean, the two words really that operate side by side are mindset and action, or mindset and behavior. And behavior is always driven by mindset. And so, understanding even the context through which our financial advice comes to us, if our grandparents did grow up in the Great Depression and they have that residue from that where they lost everything, right? Like they immediately go into this scarcity mindset, and then that gets passed to their children. And it takes a couple of generations for that to wear off. And so like if you're listening to this and you're like, oh man, this is like just too good to be true, I want to challenge you again to go back to your mindset on something and change the way that you look at things, because it could have significant impact on your family tree, the legacy that you leave, to those around you. So Sarry, I'm curious, What have I not asked you about thinking like a bank that you really wish I would?
Yeah, you asked a lot of good questions. Who's it good for? Who's it not good for? Um, I mean, maybe one thing I would ask is how does this help realtors, right? How does this help
Mm,
self-employed realtors? And I correct me if I'm wrong, but I think a lot of self-employed realtors probably don't have benefits, right? Like a
yep.
401k or IRA or things like that. Or so this would be a good idea for you to build your own kind of in-house benefit that you own, that you control for you and your company. And you could use it to fund for your other investments and savings for your family and savings and life insurance as well, all kind of wrapped together into one policy that you own and control. So a lot of people sometimes would say, I don't need life insurance. I have it through work. The problem with that is it's only going to be a term life policy that's usually like 2 times your salary. So if you make $100,000 a year and you pass away during work, then, or not during work, but during the time period of employment, then your family gets, 200,000. The problem with that is actually two major problems with that. Number one, the company owns the plan. So when you leave that company, you no longer have that plan in most situations. In like 90% of situations, you can't take that plan with you.
Yep.
And the other problem is $200,000 is not enough. You need probably 20 times your salary, especially like taking care of your spouse and taking care of your kids. If you have kids, you need 20 times that to replace your salary and to make your family whole again after you're gone. So that's just something to consider. 2 times that is nothing really. So, and some people might look at life insurance as like auto insurance. Like I already have it, I don't need any more of it. And the reality is you need usually a lot more than what you're getting at work. So even if you have a job, you're listening to this and you already have a term life policy, I'd urge you keep the policy, keep the term policy, because it's probably a good rate from work, but also look into this matter too, not just for the life insurance matter, but also for the cash value matter too.
That's super helpful, and I love the idea. I mean, you just sparked an idea for me because yeah, we're constantly in my offices. I mean, I wake up every single day, Sarah, saying like, how do I provide more opportunity for the people that do business with me? And this is just a great concept that maybe we can deploy even across my offices. So I love that. Hey, I want to transition us into the last segment of our show. Three, two, one, action. It's the same 3 questions I ask every guest. You're in the hot seat now. Okay. You ready for this?
Right.
All right. Well, question number 1 is who has been most influential on your business and why?
Yeah, my most influential is my current mentor. His name is Mark Willis. He's the host of Not Your Average Financial Podcast. He's been really, really the biggest impact just because of coaching me through this business. It's a very difficult business, and I'm thankful for him and thankful for he got me into podcasting, guest podcasting, and podcast hosting. I never thought I would ever go on a podcast. And thankfully, this is I think the 250th podcast episode I've done in the last 2 years.
That's awesome, man. Well, congratulations. And I'm glad we could be number 250. Awesome. Well, and then the other thing about that too is Mark Willis. As soon as you said that name, probably widely regarded as the best CEO that Keller Williams Realty International ever had, is Mark Willis as well. So I'm sure it's different, but he's in a company with a good name. So second question is, what book has been most influential? And I know you mentioned a couple. But which book's been most influential on your business and why?
Yeah, the book Mindset by Carol Dweck. That book is just awesome. Yeah, it's if you haven't read that book, it pretty much differentiates the growth mindset from a fixed mindset, and 2 completely different things. And a lot of people, including myself, were walking around with fixed mindsets, and the book kind of identifies what those differences are and how you can transition into a growth mindset. And it completely changes everything in business, in sports, in working out, in relationships. It changes every part of that.
Yeah, that's awesome. We talk so much about growth mindset and fixed mindset. And what I found honestly is like you can go back and forth between a growth mindset and fixed mindset, daily or weekly or monthly. And so it's a conversation that needs to stay at the forefront, all the time. All right. Third and final question. This is the All In podcast where we challenge our listeners to push the chips all in, so to speak, on their life and business to live a huge life. So specifically around the concept that we've been talking about today, having a growth mindset, changing the way that we look at something like whole life, cash value policies. If I were to take action, you were to challenge me to take action on the concepts today, like what's the first step from here?
Yeah, first step from here, check out the book Becoming Your Own Banker by Nelson Nash, or Bank on Yourself Revolution. Just there's a lot of content required for this concept, right? It could be pretty complex, but the content makes it easier to understand it. So first step, check out one of those two books. Get an idea of the concept. Also, you could check out our podcast, Thinking Like a Bank podcast. And we have a lot of episodes. We have other professionals who do the same thing, clients who are using this thing. And then you can kind of get more of like a practical approach to this.
I love that. Awesome. Well, you just mentioned a couple ways that listeners can connect with you. I know that they got value out of our conversation today, Sarry. Is there any other, links or ways to get in touch that our listeners should find more of your content, or should they just go straight to thinkinglikeabank.com?
Yeah, thinkinglikeabank.com connects everything. So my LinkedIn page is there, YouTube channel, the podcast, a free ebook you can download for free is all at thinkinglikeabank.com.
Awesome. Well, dude, thanks so much for spending some time with us. I know it was super valuable for me personally, and I hope we can have you back again.
Yeah, thanks, David. Thank you.
Awesome. Guys, this has been another episode of the All In Podcast. As always, go play All In.
Hey guys, thanks for listening to this episode of the All In Podcast. We want to invite you to find all of today's resources from our show page at aipodcast.co. We also ask that you take just 1 minute to leave us a review on iTunes or wherever you get your podcast. This is how we grow and how we're able to bring you the best content each and every week. Now go play All In.